Navitas Semiconductor closed its last active trading session on Friday, June 5, 2026 at 4 p.m. EST at an exact price of $25.08 per share, marking a significant intraday decline of 18.23% as profit-taking and valuation realities collided with recent momentum. While the regular market hours experienced a brutal sell-off from an opening price of $29.11, the after-hours trading session continued to show modest downward pressure, fluctuating around $24.54 by 8 p.m. EST. This intense volatility followed an astonishing weekly run, where the stock had surged past an intraday high of $34.17 just days prior. The immediate reality checking the market is not a failure of technology, but a massive disconnect between mechanical validation and commercial execution. This week, Navitas confirmed its direct collaboration within the NVIDIA MGX ecosystem for 800-volt DC AI data center power delivery, causing trading volumes to explode to over 112 million shares. This announcement temporarily made Navitas one of the most visible small-cap expressions of the hardware infrastructure trade, yet the underlying financials tell a completely different story. The standard expectation among retail investors pushing this stock over 300% year-to-date was that a formal blessing by major ecosystem players would immediately translate into a structural re-rating. The market operates on the belief that if you provide the foundational efficiency architecture for power-hungry hardware setups, your revenue trajectory will mirror the exponential curve of the primary chip designers. This optimism has trickled across multiple online investing channels, causing people to look at high-growth assets through individual brokerage platforms. When you look at the wider landscape, retail participants using a modern online investment application expect early-stage hardware firms to behave like software companies once they secure a marquee partnership. This expectation built a massive valuation premium, pushing the market capitalization towards $7 billion. The contrarian reality, however, is that hardware qualification cycles take quarters, if not years, to hit the balance sheet, and Navitas is currently trading at a multiple of over 130 times its projected next 12-month sales, based on an annual revenue run rate that remains under $40 million. Navitas stock is now experiencing the classic tension between structural promise and near-term commercial scale. Looking closely at the recent daily swings, the massive 18.23% drop on Friday shows that institutional allocators are unwilling to look past the severe lack of immediate revenue. While self-investing cohorts were buying the headline of the Taiwan showcase, institutional funds were looking at the first quarter numbers reported in May. Navitas delivered first quarter revenue of just $8.6 million. Even though this surpassed the conservative consensus estimate of $8.22 million and represented an 18% sequential increase from the final quarter of last year, it is still down sharply from the $14 million reported in the same period a year ago. Institutional activity indicates a massive rotation out of the stock at the $30 level, as large-scale managers realize that the pipeline conversion will be a slow, multi-stage process rather than an overnight explosion. Trading volume during the peak of the rally reached historic highs for the company, but the subsequent sell-off was done on equally heavy volume, suggesting a highly coordinated exit by smart money that understands the physical realities of supply chains. Macroeconomic pressures are further complicating the situation for early-stage semiconductor companies. With interest rates remaining a sticky challenge for capital-intensive hardware businesses, the cost of funding continuous research and development is incredibly high. Navitas reported a first-quarter net loss of $33.8 million, driven by heavy spending to build out their advanced architecture. For an individual managing their asset allocation through traditional accounts like Fidelity Investments or seeking active investment help from an intelligent portfolio, balancing a company with a negative profit margin of nearly 400% requires looking deep into cash runways. Navitas currently holds about $221 million in cash and equivalents, down from $236.9 million at the end of last year. This gives them a reasonable buffer to fund operations for the next couple of years without immediate balance sheet distress, but it completely removes any room for error. The sector momentum that lifted other peripheral hardware names is beginning to fracture, with investors demanding realized cash flows rather than long-term promises. To understand why this friction exists, we must analyze the core business model and the structural transition the company is undergoing, often referred to as Navitas 2.0. Navitas Semiconductor designs and sells next-generation power integrated circuits using wide bandgap materials, specifically gallium nitride and silicon carbide, rather than traditional silicon. The company operates a fabless model, outsourcing actual chip manufacturing to major foundries, while focusing its internal efforts on design, intellectual property, and application engineering. Historically, the company made its money by supplying high-speed chargers for consumer electronics like smartphones and laptops. However, consumer electronics margins are notoriously low and highly cyclical. To escape this trap, management initiated a structural pivot away from low-margin consumer tech to focus entirely on high-power environments, which include data infrastructure, green energy setups, and industrial vehicle electrification. This deliberate exit from consumer markets is the exact reason why year-over-year revenue dropped from $14 million to $8.6 million, as the company intentionally choked off old revenue lines before the new high-power contracts could fully scale. The technical justification for their high valuation was on full display at the recent computing trade show in Taipei, where Navitas showcased its new 800-volt to 6-volt direct current power board designed for advanced computing architectures. Traditional silicon power systems are hitting a physical wall because high-density processing setups require an immense amount of current at incredibly low voltages. If you try to deliver that power using standard components, the energy loss due to heat is massive, and the physical size of the power units takes up valuable space that should be used for computing clusters. Navitas is using its proprietary technology to deliver power at a high frequency, achieving a reported 97.5% peak efficiency and an incredible power density of 2100 watts per cubic inch. This design allows data systems to run cooler, fit more processing units into a single rack, and reduce overall utility costs. This technical capability is exactly why the company was included in major hardware ecosystem blueprints, proving that their design engineering is world-class, even if their commercial scale is still in its infancy.
This gap between engineering success and financial reality is why mainstream financial institutions remain highly skeptical. If you look at the consensus across major research desks at institutional firms, the average price target sits well below the recent trading highs, with several prominent analysts maintaining cautious ratings and highlighting significant downside risk from these elevated levels. Analysts from Morgan Stanley and Craig-Hallum have kept their targets modest because they calculate valuation based on discounted cash flows rather than structural hype. When a stock trades at an extreme price-to-sales multiple while its net losses are expanding, traditional financial modeling struggles to justify the price action. Retail traders using a standard Robinhood app or managing their personal holdings via interactive brokers trading platforms often dismiss these analyst targets as lagging indicators, but when institutional selling volume accelerates like it did on Friday, it shows that the sober math of Wall Street eventually asserts itself over market narrative. Comment below how many shares of Navitas Semiconductor you currently hold, or if you are avoiding this volatility entirely. Looking at the forward-looking catalysts and potential risks, the upcoming second quarter earnings report, expected in early August, will be an absolute defining moment for the company. Management has guided second quarter revenue to land around $10 million, plus or minus $500,000, which represents a sequential growth rate of roughly 16%. They also expect non-GAAP gross margins to tick up slightly to 39.25% as the revenue mix continues to favor high-power applications. If Navitas can hit or exceed these numbers while showing a clear acceleration in customer design wins, they can begin to build a fundamental bridge towards their valuation. The primary catalyst to watch is the conversion of their pipeline into binding purchase orders. Securing a spot in an infrastructure blueprint is a necessary first step, but the actual revenue only materializes when hyperscalers and Tier 1 server manufacturers place large-scale orders for production. If those orders get delayed due to data center construction bottlenecks or supply chain shortages and other components, Navitas will suffer disproportionately because they lack alternative revenue streams to absorb the blow. The downside risk is further magnified by intense competition within the wide bandgap semiconductor space. Navitas is not operating in a vacuum. Larger, deeply entrenched competitors with massive balance sheets and established manufacturing relationships are aggressively developing their own advanced materials portfolios. Companies with extensive distribution networks can offer bundled pricing that a pure-play designer like Navitas cannot easily match. Furthermore, any broader slowdown in capital expenditure by major technology platforms would immediately compress the valuation multiples of every company connected to the computing supply chain. If the market begins to suspect that the current build-out of computing facilities is pacing ahead of actual commercial demand, peripheral component suppliers will be the very first to see their order pipelines frozen, creating a precarious environment for a stock that has experienced such a dramatic multi-bagger run from its previous lows. In summary, the narrative surrounding Navitas Semiconductor presents a profound conflict between structural validation and financial maturity. The expectation was that a formal inclusion in top-tier technology blueprints would permanently elevate the stock into a premium tier of secure infrastructure assets. The reality is that the company remains a small-cap, pre-profit design firm with an annual revenue footprint that does not yet match its multi-billion-dollar valuation. The massive intraday drop to $25.08 confirms that the market is refusing to value this asset solely on future possibilities without seeing realized inflows. While the engineering behind their high-efficiency power architectures is undeniably impressive and highly relevant to modern infrastructure challenges, the path to commercial scale is long, competitive, and capital-intensive. Investors navigating this space must weigh the technical brilliance of the product against the extreme valuation premium, recognizing that true authority in the market is built on sustained financial execution rather than temporary narrative momentum.